Today is Friday, February 6, 2026, and the silver market has just flashed a signal that veteran analysts have been waiting decades to see. According to his latest analysis, silver has just completed what he calls a structural rebirth following the recent price correction. Over a short period, silver dropped roughly 18%, triggering panic among retail investors and calls that the rally was over. Traditional technical analysts pointed to overbought conditions as proof silver had gone too far too fast. Oliver saw the opposite. In his framework, corrections during major structural bull markets don't signal weakness, they reinforce the foundation. Like a building that needs a stronger base before adding more floors, silver used this sell-off to lock in its structural strength. Despite the sharp price drop, the internal momentum never broke down. Within days, silver snapped back aggressively, a sign that dominant buyers absorbed selling pressure almost immediately. This behavior reveals a fundamental change in the market's character. Short-term speculators exit during volatility, but structural buyers, including industrial users and long-term institutional capital, step in aggressively. When declines are absorbed in days instead of months, it signals that old trading patterns no longer apply. Oliver believes silver has entered a new phase where the most powerful gains occur after this kind of structural reinforcement. To understand why his target seems extreme, it's important to understand how his analysis differs from conventional technical analysis. Most traders focus on price levels, moving averages, and oscillators. Oliver compares that to watching a speedometer. It tells you how fast you're going, but not how powerful the engine is. Momentum analysis examines the engine itself, the force driving price over multiple timeframes. According to his data, silver has broken through momentum ceilings that have capped it for more than 40 years. This isn't a short-term breakout that can easily reverse. It's a multi-decade barrier giving way. When that happens, price doesn't rise slowly. It reprices violently, releasing decades of suppressed pressure in a compressed period of time. Oliver refers to this as lightning form repricing, and he believes we are still in the early acceleration phase. The relationship between gold and silver further supports this view. With gold near $5,000 and silver under $80, the gold-silver ratio sits around 65 to 1. Historically, during precious metal bull markets, this ratio collapses, often falling to 30 to 1 or even 20 to 1 during peak phases. Because silver is a much smaller market than gold, capital inflows cause silver to move far more dramatically. If gold reaches $8,000 and the ratio compresses to 20 to 1, silver would trade near $400. Even conservative assumptions still point to silver well above current levels. Oliver's $500 projection simply reflects more aggressive, but historically proven, ratio compression combined with higher gold prices. These projections are not random guesses. They are based on historical precedent, momentum data, and market structure. The key question is whether the conditions exist today to support such moves, and Oliver's answer is yes. Fundamentals reinforce this technical picture. For more than 5 consecutive years, global silver demand has exceeded supply by roughly 200 million ounces annually, and the deficit is growing. Industrial demand is exploding across solar energy, electric vehicles, artificial intelligence infrastructure, advanced electronics, and medical technology. Silver is irreplaceable in these applications, and supply cannot respond quickly. Bringing new mines into production takes a decade or more, and years of low prices discouraged investment. Recycling cannot close the gap. When markets ignore structural deficits long enough, price adjustments don't happen gradually, they happen suddenly and violently. Recent market behavior confirms this pressure is already building. Physical delivery demand has surged on major exchanges. Retail premiums have expanded sharply. Government mints are struggling to meet demand. Chinese markets have shown persistent price premiums over Western markets, signaling regional supply tightness. Even governments are now treating silver as a strategic resource tied to supply chain security. All of this is unfolding against the backdrop of unsustainable global debt and aggressive monetary expansion. Central banks are increasingly forced to intervene, debasing currencies to maintain stability. In that environment, tangible assets with real industrial and monetary value attract capital. Oliver believes we are entering a commodity supercycle, potentially more powerful than the 1970s because today's demand drivers are larger, global, and structural. Gold moving toward $8,000 fits historical bull market multiples, and silver, as always, provides leverage. He also emphasizes that junior mining companies could offer the most explosive upside due to profit leverage, though selectivity is critical. This will not be a smooth market. Volatility will be extreme, and sharp corrections are inevitable. But those corrections are part of the process. According to Oliver's framework, the foundation is now built, momentum has shifted, and silver may be standing at the edge of a once-in-a-generation revaluation.